as a a huge part of each and every one of these exams, but it's also going to be a super important part of what we do every day for our clients and customers, right? And it's also good information to know for ourselves. And then when we have these conversations, is what can we offer to our customers, right? So what is suitability? At its core, suitability is just kind of matching a customer's objectives and financial capabilities with the products we have to offer. And then you'll see this pop up a number of times, the SEC Rule 2090, which is the know your customer, right? So a big question that pops up over and over again, what if your customer doesn't give you all the information you need to open an account or to provide suitable information or suitable product recommendations, right? So the answer to that question is, if I'm an agent and the customer doesn't give me the appropriate suitability information, I can still open the account, but I can't solicit any trades, right? So I can't suggest anything. So I have to be all unsolicited trades. So you'll see that question arise over and over again in your Q bank as you go through. So that's something to know. All right, so this is the acronym that I kind of use for suitability, right? PIG SALT. Can anybody tell me when determining suitability, what's kind of the most important factors? You can come off mute, scream it out. Anybody? Throw it in the chat. Talk to me.
Income.
No takers?
That individuals, whether or
I'm
not.
sorry, I wasn't.
I'm sorry. Go ahead, Karen.
All right, go ahead.
Okay. I was in suitability because I missed one yesterday and had to go back and get it. But it deals with whether, the risk factor that person is willing to take. Are they afraid of risk or they're for risk? Whether or not they have the right income and what kind of income they're looking for. What was that? It was the income, their risk factor. I don't know if age was one of them. Taking the money from a place. If you need the money, if you trying to buy a home or got some big plans, you have to not use that money. Don't take no money from someplace that you should not be taking it from.
Yeah, that's huge. What comes up a couple of times, the two biggest determining factors for determining suitability is risk tolerance, right?
Yeah,
how careful would an investor be, or how risky they would be about losing their actual principal? So that's going to be a huge factor. And then time horizon, right? Time horizon is a big one. That's what you were saying. If I need the money soon, well, invest it into a growth product, which is not going to have time to compound, right? The rule of 72, that's not going to do me any good if I'm going to pull that money back out. So those are the two biggest keys when determining suitability, is risk tolerance and time horizon, right? And so
is that the one, the timing is they give you the option to put the money if you inside like the money markets, because they're pretty much structured that the money is available, it's liquid all the time.
Yep, we're going to touch on all of that. Yep, you're spot on. So this is the what acronym I like to use, PIG SALT, right? So the PIG is kind of the three traditional factors that determine suitability, and then the SALT is kind of the new ones, and we'll go through each and every one of them. So who can guess what the P is in PIG SALT? No takers. Don't worry about it. That's okay. We'll get there. So the P is preservation of principal or capital, right? So if you can do anything with my money except for lose my money. I want to make sure that the money I put in is the money I'm going to be able to get out. And we want to say what products will allow for that to be the case. So you're looking at your money market instruments, like you were saying, right? So the 4 money market instruments, and you're going to see this come up over and over again: commercial paper, negotiable jumbo CDs, banker acceptances, and treasuries, right? So our bills, notes, and bonds that mature in less than a year. Those are going to be our 4 money market instruments. And then when we talk about actual funds, you're talking about money market funds. So this was a test question on my SIE when they asked about a money market fund. So the goal of a money market fund is to achieve a NAV, a net asset value of $1. So they want to be as comparable to cash as possible. But during the Great Recession, we saw that the NAV actually fell below $1. So it is possible for a money market fund to have an NAV of less than $1. What makes money market funds so comparable to cash as well, they often have check writing privileges, right? So that means they make them super liquid. So it's like, it's as close to cash that we can get as far as investing outside of bank products themselves. And then this is what we want to use when we want to put somebody into an emergency fund, right? So if they got an emergency fund, this is the money we want it to grow slightly more than in the bank, but we also want to have that guaranteed capital if an emergency arises, as opposed to pulling from a mutual fund with growth or from a retirement account, which they'll be penalized from, right? So this is what we want to put them in. Super important. All right, the I stands for income, right? So this is somebody that wants income, right? So what provides income? Those bonds or preferred stocks, right? These are fixed income instruments that pay either interest or dividends, right? So the interest is paid how often?
Semi-annually,
Semi-annually. Dividends is paid how often?
quarterly.
So if I asked someone to give me the current yield on a 5% bond that's trading at a premium of, let's say, $1,010, what would that answer be? Anybody know how to do that math?
Quarterly income.
No. So we're talking about a bond that's paying 5% interest. What's the current yield if it's trading at a premium of 1010?
Oh, you got me. I'm still confused with that one. That's one of my problems. That current yield, year to maturity, year to call.
So we go back to our bond seesaw. Let's just say if the bond is trading at a premium, would the current yield be more or less than the nominal yield?
It'll be less.
Less, that's right. So the current yield is 5%, and then the bond is trading at 1010. So what we're going to do is we're going to take our the interest payment, right? So the yearly interest payment is going to be $50 on a 5% bond, right? And then we're going to divide that interest payment by the actual premium price. And that's going to give us a percent. And so we know that the percent is going to be less than 5%, and it's actually 4.95%. But that's how you do that math. Calculate current yield is super important. I'll put a video in the chat if you're still confused on it, but you really have to know how to calculate current yield. You can calculate it on each and every test. Does that make sense to everybody?
Yes, I'll be calling you again on that one.
Sure. So it's just the interest payment divided by the price. And that's going to be your current rate. I put it in the group, but we can definitely chat, and I'll post a video in the group, like I said. So who's familiar with tips? Oh man, we ran out of time. So what is a tip? Anybody?
Tips.
So that's a Treasury inflation protection security. So this is the actual fixed. Well, it's not a fixed. So this is an income, a bond that actually keeps pace with inflation. Doesn't outpace inflation. It keeps pace with inflation. So it's adjusted semi-annually based on the inflation rate, right? And it's designed. The big piece for you to know is that it's designed to keep pace with inflation. So it's going to. So if a person wants to say, I want income, but I don't want to lose out to inflation, let's put his money in tips. All right. So the next thing in the pig saw is the G. So preservation of principal, income, and growth of capital appreciation are three classical determinations for suitability, what people actually look for when they come into your office and say, what can you do for me with my money? So growth is probably the biggest one, right? This is we want somebody to invest and invest early, right? So this is equities, right? So this is what is the stocks. This is where we put our money in stocks. We want to traditionally has the best hedge against inflation, right? So the historical inflation rate is around 3%, and returns from the S&P historically has been around 10%. So this is what we say when somebody wants, if your money's in the bank, it's going to lose way to inflation. So your money is losing money. And you put your money into the stock market, and specifically the S&P 500 or any of those stocks, you're going to typically outpace inflation and your money's going to grow, right? And so this ranges from your speculative stocks, which we'll talk in a second, growth stocks, which are growth stocks, which we typically expect to grow more than where they're at now, versus our value stocks, our blue chips, right? So we look at companies like Tesla, which is a growth stock still. Guys, that's further along. Anybody heard about the PE ratio, or price per earning?
I've heard that before, yeah.
All right, so that's just the stock price compared to the company's earnings, right? So in growth stocks, they have a high stock price, but they're not earning a lot of money. So that PE ratio is high. So that the growth is baked into the price, but not the earnings haven't caught up yet. And so you look at Tesla, which is like a growth stock, still has a PE, I think 50. Where you look at companies like GM or GMC that has a PE ratio 5. Right? So they're like our blue chips. They've been around. They're going to pay dividends. Typically, growth stocks do not pay dividends. They're reinvesting in the company, right? So you'll get that question come up a couple times too. All right, so the S and P are the speculative. So these are our speculation, right? So these people that want to take on more risk. Again, that's going to be in our equities, right? So these are our tech stocks, our pharmaceutical stocks, our sector funds, right? Biotech. These stocks typically have a high beta. Anybody know what beta is? So beta is used to determine volatility, right? So these are stocks that's going to take big swings. When the market moves, these stocks are going to move more than the market, right? So in these stocks, we're betting on growth from either new technologies or medications. But these stocks can boom or lose, right? They're new on the scene, so we want to try to bet on them. Say, let's see how far this stock can run up, right? These stocks that's just IPO, let's see if they run up quickly. So it's just taking a guess or a bet on a new stock, or a stock that has possibly some new technology, right? So these are speculative investments. So these are for more aggressive investors. And then, like you were saying, Joyce, liquidity is going to be our L in SALT, right? So these are typically our money market instruments. Like I was saying, they typically have an NAV of 1. They're supposed to be close to cash. So our money market instruments and our money market funds are stocks that's traded heavily on an exchange, and then mutual funds, right? So we talk about stocks that's traded heavily on the exchange. We can go on Robinhood or any of our apps and we can sell or buy stocks immediately, especially these big companies, right? And then what makes mutual funds so liquid? This is a super important point on mutual funds. Why are mutual funds so liquid?
Is we're talking about, because most of them are open end, like with the open end.
Right. So mutual funds are super liquid because the issuer has to redeem your shares once you actually redeem it, right? And the issuer has to redeem those shares within 7 days. So anytime you have a mutual fund, the instant you want to redeem it, the issuer can't say, no, we can't redeem it. They have to redeem it by law within 7 days, which makes mutual funds inherently super liquid. So that's what liquid means. Just get out of the investment, get out of the investment quickly if a need for cash arises. But when you're talking about liquidity, you also have to consider the cost, right? The cost of the trade, such as commissions, the sales charge on those back-end mutual funds, the contingent deferred sales charge, right? So you got to make sure you're looking at all those things when you're factoring in liquidity. And that's why money market instruments are probably the most liquid instrument, because they don't, for one, money market funds don't have a sales charge. And like I said, they come with, most of the times, check writing privileges. So they're the most liquid of your investment vehicles. And then you got to consider taxes, right? When somebody's in a high tax bracket, just think about municipal bonds, municipal bonds. for some reason, these exams don't really care about state taxes. Of course, state taxes are generally less than federal taxes. So you have somebody that's in a high tax bracket, you want to consider putting them in a municipal bond. So anytime you see a question about a high tax bracket person, look for municipal bonds, right? And then we can walk through this at another time. We can probably pick it up next week, but how to calculate your tax-free equivalent or tax equivalent yield, right? So you have a tax-free bond. You want to know, with me investing in a tax-free bond, what type of return would I need from a tax bond to give me the same return as a tax-free bond? Or if I can get more return on the tax bond, should I invest in that? And so we'll walk through this probably next week when we have a couple more minutes. So this is actually out of Kaplan, and it's in the 65 videos. It has those different suitability recommendations. So preservation of capital, income, capital appreciation and growth. Your speculation is in the middle, your liquidity, and then your tax advantages. And this is a list of those things. So when you get further along, you'll start getting to some of these other things. So of course, when we talk about preservation of capital, money market funds, money market securities, our CDs, all the things we talked about. And then we talk about income, we all talk about bonds, right? Whether it's actual like a debt instrument or like a preferred stock, right? And then you talk about growth, you're looking at common stocks and common stock mutual funds. And then you'll read about REITs and DPPs. They'll come up a little bit later, right? And then speculation, that's when you get into your high yield bonds, right? Or those junk bonds, or you get into those sector bonds, right? And then we talk about liquidity, back to money markets, your cash and demand deposits, right? Those just checking and savings accounts, and your T-bills. And then we talk about like tax advantages. We also talk about municipal bonds, right? So you'll see that. And then this is a chart I stole from my coach, Mike Evans. This is historically the returns in each of these markets. So it's the further you go to the right. So risk should always
stay at the bottom.
Risk should go with reward, right? So if we move to the right on this chart, the more risk we take, and that's actually the more rewarding we get, right? So it should be linear to each other. As you can see, when we look at a mid-cap stock, which what index tracks mid-caps? Anybody know?
Index that track mid caps is the.
Is that the S&P as well?
So the S&P 400 tracks mid-caps.
400.
And the S&P 500 tracks your large cap stocks, right? And so we look at these large caps, we say traditionally you have been a 10% return. While we talk about the rule of 72, right? And we talk about how banks are doing our clients wrong because they get less than 1% when the bank put your money into an index fund and they make off with 9%, right?
Yeah.
They charge you 20% on the credit card. And then so as we go up, we see like international funds. What index tracks an international markets?
Is that the NASDAQ?
So the EAFE. So it's like the Euro Asia Foreign Exchange.
Yes.
So the EAFE, you'll see that it tracks the international markets. And then here we just have emerging markets where he's at, which are more speculative, right? Those in like your third world countries where they're actually like building an infrastructure. Those are emerging markets. And then anybody know what the UYM is? That's the under your mattress money. So that's getting no rate of return, right? If you got a pile of money underneath your mattress for safe keeps, you might want to put it in something, being like a muni fund, right? To actually get some.
I was gonna ask what that was.
So this is a good thing to look at and know our products and what would best fit our client for what they're looking for as far as growth and risk, right? So risk should always be compared when we talk about risk and reward. And then this is a star. So this is annuity. So when we think about putting somebody in an annuity, we always got to remember that annuities are a supplement to retirement income, not a replacement, a supplement. So we want to make sure that the person is properly insured with life insurance and that they maximally funded all their other retirement accounts that has tax favorability, right? Must be funded with cash. It's not suitable for someone that needs a lump sum of cash, right? Because it has to take time to grow. And we got to consider the risk tolerance for variable annuities. We put somebody in a variable annuity, we know we can lose our money versus an index or a fixed annuity. Right. Anybody got any questions about what we just talked about? This
I
is-
want to make
this
sure
is-
that the A in SALT was the capital appreciation.
No, the end salt is just for fun.
It was a what?
Just for fun. The end
Oh.
salt is just a placeholder.
Oh. I'm making up stuff now.
Yeah,
Don't
so it's just
I thought a little A. Look, I thought it.
it's 6 things, right? So PIGSLT, the salt is just to make it a word.
Okay.
That's just to make it a word.
Okay.
But this is super important for all your exams. I really wanted to get this out there before people start testing. So any questions right now is the time to ask them.
Coach, can you pull that pig salt slide up again, please? I just want to make sure I got everything.
Absolutely.
It was, because I missed one of the letters too. Okay, yep. Thank you.
Growth is what it was.
That's what it was. Okay, thank you.
Cool. If it doesn't, any of this have any questions, you can also ask me offline, throw it in the group so we can all learn together. But you have to get this down. This is going to be key for everything we do. Cool?
Yes, sir.
All right, teammates, close out. We'll see y'all next week. Let's get it. Everybody should be gearing up to test, gearing up for convention. It's going to be so dope. Can't wait to see you guys down in Atlanta, man. We're going to have a blast. It's going to be lit. If y'all have any questions, my number is pinned in the group. And don't post your quizzes. And if you have any questions, also put them in the group. Like I said, let's let everybody learn together. Cool?
Yeah.
Thank you, Coach.
Cool. Thanks, Coach.
Thank you.
Thank you, Coach.
Thank you. Yes.
Thanks, Coach.